Hi guys, today I wanted to talk to you about the ETF funds to invest for the long term. Basically, this is equity based. Equity based is nothing but stocks, investments in stock funds, stock in funds which invest only in stocks. This could be even REITs, technology sector, biotech sector, retail sector, etc., etc. But very well diversified in all these areas of the market. So the way how I would approach this methodology is whenever you are planning to invest in funds for the long term, just like how you invest in your 401k or your IRA or Roth IRA or even your own brokerage for account that you're planning to invest in, I would prefer to take this methodology if you're investing in ETFs, especially index investing for the long run. You can do the systematic investment plan approach. This is basically taking small amounts of money from your paycheck or from your bank account where you have your savings in a smaller amount and investing it periodically. This can be done through different ways of setting up your brokerage account, like directly taking some smaller amount and putting it into a fund of your choice. This can be set up. Actually, you can talk to your brokerage firm about it if they support it. If not, you have so many brokerage firms which does it with very low fees. And also some firms like Robinhood app, if you haven't used it, please do research on it. It's a free app, free trading, zero commission. And they have different platforms within the Robinhood also where if you want to use a margin account, which they will charge you, but do not go with a margin account when you're investing for the long run. Set up the systematic investment plan approach based on your investment style and your risk tolerance. And just like how you pay for your car insurance, mortgage payment, your health insurance, etc., you set this up similar to that. That way, you are investing a small amount of your money into these funds, which will do well on the long run. And the reason why you want to go in this approach is because you don't need to time the market. In this case, let's say the market is at low or at all-time highs, you are not buying or putting all your investment when it is at all-time high. You're just putting a fraction of your wealth into it. That way, you're not timing it. So you will be good even if the market turns down. Not that I'm saying that you will be positive. You will be, since you're doing it systematically, you will be purchasing shares even when the market is down. So when that happens, you're basically averaging down your cost. So when that happens over the long run, you get a better result on the long run. So not that I'm saying that you will be good if it's really a time when recession happened and you have no choice but to withdraw. That's a different story. That depends on your risk tolerance. But what I'm saying is over the long run, for majority of us, this works. So if your timing is bad, that's a different story, and that's the reason why we go with this SIP methodology. Because even in a downturn, when you average down your cost, it should do well. And try not to withdraw the money from this fund that once you have invested just because the market went down. It doesn't work like that. You invest your money on the long run, and based on your uh, increments that you will be adding the money into this fund over the long run should save you on an average cost basis. And try to avoid firms which charge you a trading commission. This can be easily achieved by opening a Robinhood app account and also setting up an account with some of these brokerages which give you free trading on ETFs. There are so many out there. I believe Fidelity is one of them. I think so. I'm not sure, but do a research. Vanguard, if you open a fund within, account within Vanguard itself, they allow you to trade freely their ETFs, Vanguard ETFs. Similarly, you can trade with Merrill Lynch also. They will give you your own. If you are a platinum based or a preferred rewards member, you would get like 30 or up to 100 trades free per month. So, which is more than enough. You are not going to play a lot of stocks, a lot of ETFs. You'll be investing in one fund particularly, one or you can diversify as long as you are looking for growth, in, growth and income again, and a regular indexing fund, and also emerging markets if you want to be exposed to that as well. So these are the three ones that I wanted to go with you over. One is the total market fund, which the ticker symbol is VTI. The management fee is just 0.04. This is one of the uh, key funds which many people out there in Vanguard, Bogle hedge firm discuss about. This is a very good fund, stable fund. As you can see here, I'm going to show it to you the last few years return. This is the past performance. So past performance is generally an indicator of how well the fund has been done in the past. So it doesn't mean that in the future it will guarantee you the same returns. But this is something to look at which will show or indicate to you that these are some of the very good places to invest your money or park your money in for the long run. Even if the return is 6 to 7%, that's still a return. Where else are you planning to get that kind of returns? Banks nowadays are not even yielding that much, but since it's a rising interest rate environment, you never know. But invest in the stocks for the long run. Stock index funds. So if you can see here, the VTI gave you an average return on the last 3 years, 22%. So 22.9 divided by 3 should give you like close to 7%, which is not bad, 7 to 8%. Last 1 year it gave you 15.81, but overall it's giving you a 7% return, let's assume. It's still not a bad return. If you calculate it and try to compound your wealth, this is a tremendous amount over the long run. So try to invest in this fund if you feel like, if you're comfortable in it. You can see all the details here, the management fee, etc., how much asset it's been holding. You can see all these performance. Similarly, now let's see the Schwab growth sector. The reason why I wanted you guys to see this was because you always need some exposure in the growth area as well, because these are the companies which will be leading the market in the next 5 years, maybe in the next 3 years, maybe in the next 2 years. We do not know. So you also want to diversify in this name. Let's look at the returns. Year to date 14.28. This is a tremendous return when compared to even my own stock picking strategy that I am following. This has done phenomenally well. I was like close to 13%. This is like 14.2%. Mine was like 13 to 11%. Yeah, based on my stock portfolio size, of course. So the last 1 year return was 20%. That's a tremendous return. Last 3 years, 31%. Again, this is like averaging like close to 11%. This is again a phenomenal return in my view. But let's say you have an account which is of a smaller size. These are like, you might think this is very minimal return, but you need to get started somewhere. Don't think the way how you see some of these people who promote stock tips or stock alerts telling you if you invest in their alerts or their methodology, you will make like more returns than an index. That's the wrong approach to take. Over the long run, I'm pretty sure you have no clue what you're going to do with all these market moves up and down, and market keeps changing every day. It can start with algo tradings, the high frequency tradings, that what they call it today. Tomorrow it'll be something else. Some different ways of making money in the market. So you need to learn to adapt if you are going in that direction. And I think that's going to be difficult for many investors out there. So this is one way of diversifying and getting, you know, building your income to some extent in a stable and easier way. The other fund I wanted to talk to you about was the Dividend Aristocrats Pro Shares Fund. This is by BlackRock, I believe. They basically um, invest in Dividend Aristocrats, the top companies within the S&P 500, which has paid for last 25 years or so uh, dividends that have been increased, and they have also a good growth potential. Not the way how you see in the growth ETFs here, but they grow over time by either purchasing some other company or in their own sectors by going into the developing or emerging markets and things like that. Here also, if you see, you have a dividend yield of 1.91%. Over the last 1 year, the return was 6.95, 6.94, and year to date was 7.53. Don't get distracted by this low returns over here that you see. This return is still phenomenal if you look at the overall market. This is a way of diversifying. I'm not saying that you need to go in and put here or in this particular fund. It's up to you, it's up to your discretion to know what you're doing and how to get better results or better return. The management fee is higher, but just because the management fee is 0.35 doesn't mean that you have to be discouraged from investing in it. The key mm, to earn in the long term is to make or to grow your account sizes, basically being invested. If you are not invested, this will not work for you. Don't look at these key numbers of like 8%, 10%, 10%, 15%. This will never work for you if you are not going to invest even a single penny. It's not for you. The first methodology is to invest. If you do not, you have to come up with a systematic investment plan or a different methodology to invest money. If you do not invest money, you are not going to gain anything. Even if you put $100 a month out from your account, it still makes a lot of difference. So there's a lot of ways to calculate this compounding. The way how this compounding works, you can create a spreadsheet and do your compounding on 7% return on the amounts that you invest. You will see what I'm talking about. Over the years, it will grow exponentially well. Okay, there are so many calculators out there. You can do a research like this. I believe there is an online calculator out here somewhere which I've used. Okay, let's say your current age. You can come over here. This is a free tool. Guys can go ahead and look for it. You can find so many other calculators. My age, let's say, assuming now I'm very old. Let's assume it's 32. My expected retirement age is 55. Very conservative. Okay, beginning age of contribution, let's say. If I had started at the same age right now and my rate of return was 7%, let's say, and since I said like how much, $100 per month, and so for 1 year, my annual contribution will be such and such. And currently, let's say I do not have any investment. How much did I make for the next 5 years? It became 64,000. Okay, so 23 years gave me this much amount returned back. Indirectly speaking, 1200 into 23 would have only given me this. And if you see, I made a huge savings over here, three times almost. But let's say I increased my contribution, let's say, and I put 200, let's assume, okay, 200 into 12, 2400, let's say. I almost am tripling each time, right? But let's say I did something else over here. Let's say if I had invested from the age of 22. Look at the difference. And I'm giving you a conservative number of 7. I do not want to go above 7. So I'm being very conservative. So you can do a plan over here and consider, is this an amount that is enough for you to retire? I'm not sure about that, but it depends. Again, the more you invest, the better returns it will be over the long run. So be very conservative in your investment methodology. If you do not invest, it's going to be a retirement where you're going to be broke. You will have to be supported by some of your family members or whoever you have in your life at that time. So this is one of the ways I would definitely suggest you to make use of to calculate it. So go for the long run. Okay, investing is a timely process, so it doesn't happen overnight. So you need to be careful on what you're doing. Also, in addition to that, I forgot to mention to you guys, you can use this bogleheads.org. This is a website where you can get great retirement tips or financial tips. You can ask any questions in this forum, they will answer you. These are people who have run this community based on their inspiration from Jack Bogle, a very wise investor for times who was the founder of Vanguard and who has also told us to keep investing in the index fund over in the long run. You will get lots of ideas as to why I'm telling you this. Another thing I found within this website was, if you want to really diversify, some people are very much scared of diversification, if they are not well diversified, what's going to happen? So you can take this three fund portfolio approach. This is the simplest of them all. Okay, you can diversify yourself in all these three sectors, which will cover you almost anything, any combination you can think of. This these funds do have exposure to the REIT sector also. Okay, it does. So you can do a research on that. Do not just be diversified by picking sectors. That doesn't work like that. You need to diversify maybe in this way or maybe in this way. So it depends on your taste. And there will be equivalent, these are mutual funds actually. There will be equivalent ETFs out there also. The reason why I would prefer ETFs is it's very much liquid and you can get in and get out, less fees, etc. But the disadvantage of being in an ETF is you have the tendency to trade back and forth because it's a liquid market. So you will always have the tendency to get in and get out whenever you see a correction or whenever you see a profit. So that's the reason why for some people ETFs are not the good way to go around because you have the tendency to get out of the fund. Apart from that, for people who are really rich or like based on your age, you want to be in a stable fund, bonds are the way to go, maybe some other stable funds, but the returns will be very nominal, like 3% return. So on your investment ROI. So I wouldn't suggest until unless you really want to be very conservative to go and put your bets in these names. And in a rising interest rate environment, I'm not sure at all if this is the right way to go. Talk to your financial advisors. And also one more thing, I think I would have discussed this. If you want to hedge, you have these options. But whenever you use these options, you need to be very careful with what in terms of knowing what you're doing. Do not go and simply short because the market started going down all of a sudden. You need to be very vigilant and know what you're doing. I would suggest over this to stick with your systematic investment plan. That way you know you're averaging down your cost. Because generally overall the market will always be towards upside and you want to make sure you are always averaging down. And make use of this retirement calculator which is provided by Edward Jones. This will give you a rough idea. You don't need to invent anything. You don't need to create a spreadsheet. Keep looking at it every day. You are returned. What is it going to be? How are you planning to retire? So make use of this. So that's it for now, folks. I'll talk to you guys later. And if I have some other ideas and some other theses that I'm planning to share with you guys, I will let you know. Thank you and talk to you guys later. Bye.